Live from Singapore, this is Insights with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. A global bond sell-off accelerates in Asia. It was sparked by a sudden drop in German bonds on a dramatic change to the country's spending plans for defense and infrastructure. Meanwhile, equities are in high gear after President Trump exempts automakers for a month from the newly imposed tariffs on Mexico and Canada. Meanwhile, mainland Chinese and Hong Kong stocks gain in the afterglow of a positive NPC. Plus, we hear exclusively from CEO Rene Haas about his firm's role in helping Malaysia achieve its $270 billion goals for its chip industry. And it's not just the chips industry. The demand for AI is also reshaping the property market. PGIM Real Estate's co-CEO and global COO, Cathy will be joining us for more on that. Our top story today, Asian stocks edging higher after a delay to some U.S. tariffs on Mexico and Canada. Meanwhile, a rout in German bonds has reverberated through global debt markets. Our markets reporter, Avril Hong, joins us now for more. And Avril, you can't help but feel that, that sense that volatility is in the air.
It is, and I think markets are also feeling a bit vindicated to have been skeptical about tariff implementation after this auto reprieve for Mexico, Canada. We're also hearing about potential carve-outs for agricultural products. So markets running on that idea, and we're seeing the region's benchmark extending gains from yesterday, highest in more than a week. And these levels you see on the MSCI Asia Pacific take us to levels we haven't seen since before the Friday crash. Now, we're also seeing Chinese stocks running high on policy support in the face of external pressures. What we heard from the NPC has gotten investors cheering, that tech consumption focus. We're going to be watching out for a briefing later this afternoon from the chiefs of securities, finance, central banks. Flip the board, because as Trump kind of pulls support out of Europe, the Germans have had to step up their game. They're doing this in the form, as you know, of infrastructure, defense spending. So they're unshackling those fiscal restraints. That's led to a rally in stocks. But also for German bonds, the worst day since the aftermath of the fall of the Berlin Wall. And that pain in bonds is also spreading to Japan's bonds markets. Flip the board, just look at also what we're seeing in terms of the crosses, particularly for the euro against the greenback. We're not seeing this level since November last year. But if you're wondering, does this surge in the single currency have room to run, consider this chart from MLife's Mark Cranfield, and it shows you it's really not just a dollar theme when you look at the euro, Haas.
Lots to digest there. Avril Hong, thank you. Let's get the perspective of Charu Chanana, Chief Investment Strategist at Saxo. Charu, good to have you with us. Let's start with the euro. That's where Avril ended. The best rally since 2015. I mean, more upside from here.
I mean, of course, it was only a month back that we were probably talking about a parity on euro-dollar. But this massive shift that we've seen in Germany, and potentially there's this EU Council meeting today, potentially pressuring other EU members as well to kind of, bring up their game. This is a massive turnaround, historic turnaround, as Avril just mentioned, right, in their policy stance. And we've had, years of underperformance in, say, European equities as capital moves out potentially from the US, goes into Europe. There's quite a bit of room there for euro to continue. I mean, I think we're just getting started there.
So massive spending. Some say that we have not seen this kind of spending since the 1990s in defense as well as infrastructure. So when it comes to a trickle-down effect to the euro, which has seen a massive move as well, I mean, how much more upside from here, you think?
I think there is quite a bit of room there because for now, this is a policy announcement. You see the implementation. There is likely going to be a lot more focus on the industrialization of Europe there. So, capital flows in. As that happens, of course, the euro tends to gain. And on the other hand, you also have the US dollar coming under pressure. I mean, we've been talking about US exceptionalism for years now. Calls around US recession in the last year and the year before before have not come to fruition. But right now, data is really suggesting some weakness there. I mean, the ADP numbers, the private jobs numbers yesterday were exceptionally weak. And if we were to see something of that order come through, in the NFP data on Friday, I think that is a huge signal to the Fed, which has been sitting on the sidelines. But the traders, the market has already started to push for more Fed rate cuts, because if you do see unemployment rates going up, I mean, I think the Fed has to step in there. And that kind of brings more reasons for underperformance of the US dollar. And that again bumps the euro higher.
Charu, am I hearing right? Because even as recent as last month, people were still touting U.S. exceptionalism. People were still touting Mag 7. You're saying time to rethink.
I would say I think we're at the brink of that. So far, when you look at the economic data out of the U.S., it's been pretty mixed. And there has been a story, I mean, Saxo's talked about it for a long time, that there is a divergence in the U.S. economy where, of course, the wealthier are doing well. It's the bottom part of the population which is not doing that well. That divergence is certainly, I think, getting more and more nuanced right now. And we've seen a lot of survey data where you talk about the present situation and the outlook. So the outlook sections of those surveys data has started to indicate a lot of caution. Whereas if you look at the current data, I think that's obviously not signaling a massive turnaround there. But if that survey data starts to feed into real data in the months to come, plus you club that with the fiscal, the DOGE efforts of the US administration, that kind of obviously brings, I mean, it was really that fiscal push, the CHIPS Act and the spending around that actually got us to this US exceptionalism in the first place. If we do see a pullback on that, I mean, there's more and more reasons to believe we could see a quick turnaround of that story.
And just like that, Treasuries no longer the only game in town. You have to look at the bunds now, the massive moves that we saw in the yields. I mean, 30 basis points? I mean, nobody expected that.
Absolutely. I mean, again, it's a story around the fiscal divergence, right? And tariffs is a huge story as well right now. And, when you talk about tariffs, there's always this debate. Is it inflationary or is it a problem for growth? And I think the treasuries are really giving us a signal as to what the market thinks about it. The fall that we've seen in treasury yields clearly indicating that markets at least think that tariffs are more of a growth problem really than an inflation problem per se. But of course, on the contrary, you have things in Europe looking a lot better, not just on the defense spending front, but also we know ECB has front-loaded some of the rate cuts. And today we have another ECB meeting. We could potentially see another cut. But the language around it is likely to be very, very different because there is some amount of fiscal expansion happening. They need to wait and watch what that means for Europe's inflation. So they probably need to pause after this rate cut today, and that will be reflected in their language.
So Europe is one to watch. If you want to play the market, is it just about, infrastructure? Is it just about defense? How best do you play Europe? How do you get exposure to it?
I think for now, it is those two themes particularly, or I would add a third theme to it, which will be around energy and how they really change their energy game. There's obviously a potential that a lot more cheaper energy could come back, especially if we were to see the geopolitical side of things calm down a little bit. And that cheaper energy further fuels a lot more traction in several other European sectors as well. So I think that would be a third theme to watch. But obviously the immediate focus right now is on defense spending. I think that is the priority. Whatever extra, fiscal plans they're able to push through, I think the first focus will be on building their defense infrastructure. I think along with that, it will also be about infrastructure and energy. But whether or not they really take that push in fiscal spending towards technology or not, I think that will really decide whether this outperformance of European markets can be sustained or not.
Because we're already seeing the spillover, the ripple effects on Asia. We saw how the bond market affected JGBs, for instance, 10-year yields for the JGBs at about 1.5%. How will this play out? And is it just Japan that you're looking out for? Are there other markets you should also be paying attention to?
Certainly the bond markets in Asia are the most active in Japan, and that's why we've seen that reflected there as well. Plus, we also know that the Bank of Japan is on a very different rate path compared to the other central banks. I mean, they are hiking rates. Obviously, the timing is a little bit debatable there as well, but they are on a path of hiking rates. So certainly, it's an easier way to filter through. But I think other than that, most of the Asian markets are still very much dependent on what comes through from the US policies, the tariff policies particularly, which are the key focus right now.
Not to mention China as well.
China as well. I mean, yeah, of course, there's been a huge focus, last many, many weeks, but also particularly yesterday with the NPC announcements, I think all of those things really factor in a lot more for the other Asian economies than for Japan itself, where we've seen the filtering through of that German Bund move a little bit more.
So with expectations of the BOJ moving, never mind the timing, we've been waiting for that for a very long time, you can only expect the yen to rise from here. Add to that, the warnings from Trump himself saying that, we're watching out for movements in the yen.
Absolutely. I think the factors for yen strength are very much in place. We talked about the US dollar losing its shine potentially. That could go a little bit further, I think a lot further perhaps. And you have the policy divergence playing out if the US economic weakness forces the Fed to cut rates some more. And, we just talked about the BOJ hiking rates as well, at least being on that path, if not doing that aggressively. That's there. And this whole uncertainty, right? There's tariff uncertainty, economic uncertainty, geopolitical uncertainty. All of that plays into the Japanese yen also potentially getting back its safe haven status. And then, like you mentioned, the Trump's threats as well, that is further reason to bring the Japanese yen closer to its fair value, if not stronger.
But the thing is, what's fair value? How much will upside? We have the likes of BNP saying, 15, perhaps even 20% upside for the yen from here.
I mean, it has been undervalued to that extent, and I would not disagree to that. I mean, there's potentially a lot of room for the yen to rally from here. But what is surprising, I would point out, like, for example, yesterday was a huge move in the US dollar lower. It was a massive one. But the Japanese yen was not able to rally on the back of that. I think the bulk of the move came on the back of euro. Some bit also on the back of other risk currencies, Aussie and Kiwi. So it was that US dollar weakness, but it was playing along with an improvement in risk appetite. And that's potentially why the Japanese yen could not, it's stuck at that 148.5 kind of level, which is getting really, really hard for it to break. But once we see, I think, that being broken, I think there's a lot of room for the Japanese yen.
Is it a case of seeing weaker data out of the US that would be the catalyst for the yen to go higher and break the range that it is at right now?
Absolutely. That is one very important criteria. But we've also seen in the last several months that the Japanese yen has become extremely reactive to Japan data as well. You talk about inflation, wages. If we do get those numbers out as well, and the traders, the market is able to bring up the expectations of BOJ rate hike, that has not impacted yen in the past. It has been hugely dependent on the US data side. But things are changing. Certainly the momentum that we are seeing in Japan economy, markets continue to see continue to want to see more and more proof of that. And as we see that, I think that is also a reasonable catalyst to expect.
And things seem to be changing for China as well. On the back of the NPC, we saw how, the CSI 300 rallied. I mean, people are saying perhaps it is a catalyst for it to play catch up to the HSI, for instance. What's your own takeaway? Where do Chinese stocks go from here?
I think the divergence story there could have room to run. I would be a little bit cautious in saying how CSI could play a catch-up, because the representation of tech stocks in CSI 300 has been a little bit less than the Hong Kong listed exchanges, and it has been a lot about the AI story in China, which has brought up this performance in recent weeks. But of course, they touched all the right notes yesterday with their NPC announcements, whether you look at it from the perspective of growth target, fiscal deficit, inflation target.
But even then, the 5% growth target, some say, is not really going to be easy to achieve in 2025.
Despite that, despite the threat of tariffs, the fact that they're coming out with a growth target of 5% and not bringing it lower to 4.5%, for example, is a positive signal on the amount of stimulus measures that they have in the pipeline. Now, it is all about implementation. China has underwhelmed us on implementation side many, many times. So we really need to watch how things go from here, how big the tariff threats get. But they were at least able to meet the market's expectations, which they've not done in the past. In the past many meetings, we've seen them under-delivering on markets' expectations. So that was not the case this time. But I think the divergent story that you pointed out, I think we really need to see more on the consumer side, on the property side, which is, consumer side is picking traction. The property side has a long way to go. It really needs structural reforms.
The stars seem to be aligned for Chinese tech. I mean, we have Alibaba coming out with his own AI model. Yeah. Open source. Yeah. And we're seeing the stock rally 7% on the back of that. This is on the back of the massive rally we've seen, I think 50, 60%. I can't even keep track anymore. Yeah. Are Chinese tech the way to go in China right now?
I think that is really the biggest story right now in China. I think...
is that the biggest opportunity in China?
I would be a little bit cautious on how big an opportunity that is, because as much as the fundamentals are there in China, it is also a lot more about regulation. And we've seen regulation not being supportive of that kind of innovation in the past. Certainly things seem to be turning, and that's what is getting the investors excited about the opportunity in Chinese tech. And of course, you play that with the valuation divergence that we have compared to the Mag 7, for example. There is obviously a lot of room there. But of course, when you are investing in China, you have to be a little bit more tactical and alert to the regulatory announcements as well.
So what do you buy?
In China?
Yes.
Absolutely. I think I would still, on a tactical basis, I would stick with tech for now. I would look at probably more implementation on the consumer stimulus side and, probably extend that side as well. I think green energy, that is a huge focus for the Chinese authorities. So I would stick to these strategic priorities for the Chinese administration because, like I said, regulation can play a huge part in your investments in China.
When you take a look at the market right now, it has to digest a lot of noise. They say, shut out the noise, look at the fundamentals. But right now, fundamentals are also reliant on those noises because if some of the noises actually become reality, valuations change and the dynamics in the markets also change. What do you focus on and how do you decide where to put your money?
No, that's a great question, Haslinda, because yes, when we talk to long-term investors, it is a lot about, yes, ignore the noise, focus on the fundamentals. But this new regime, this new administration that we have, the whole change that we're seeing in Europe, in China, I think this is bringing a new kind of an investment regime, and even long-term investors need to adapt to that. You cannot have a static portfolio and expect it to continue to outperform in the next 5 years as well. So I think, these strategic priorities around defense, for example, around technology, for example, I think these are some things that have are changing the fundamentals of the game, as you said, and even long-term investors need to adapt to this to continue to have a more resilient portfolio in the coming years.
Which asset class will do the best in 2025?
I think there's still, I am still more inclined towards equities. I think there is going to be some divergences, maybe like, so a balanced equities portfolio, say US, Europe and China. Gold is absolutely important because of the levels of uncertainty, because central banks are buying it. So I think gold remains a very important part of the portfolios, but I would wait for a pullback, a little bit of a stronger pullback to get in there, if not there already, but continue to hold on if I already have it. But overall, I think I'm more of an equities person as a long-term investor still.
All right. Charu, thank you so much for that. Charu Chanana, Chief Investment Strategist at Saxo. Time for the active investor. Coming up on Insight, we'll look ahead to the big economic briefing expected in Beijing later today after China laid out its policy playbook for the year. Keep it here with us. This is Bloomberg.
The interesting question is how can China achieve the 5% GDP? The confidence on the China's tech and Xi's model of focusing on high quality growth is actually coming back quite a bit. If we look at the equity market, that's one area that can potentially drive the growth without the traditional stimulus.
What they're really saying is focus on the quality sectors that can create jobs and can create growth for the economy. So there's a fundamental signal there that underpins the willingness of the market to consider a better outlook.
But overall, for mass market consumption, we have to see a sustained improvement in employment. The fast adoption of AI and robotics, humanoid robotics, and I think the first rounds of the impact would also be negative for employment and income growth.
Some of our guests sharing their insights on China's latest pledges at its annual parliamentary session. And China's finance and securities chiefs will hold a news conference later today from the NPC. Bloomberg's China correspondent Min Lo joins us now from Beijing. Min, what are we watching out for from this presser?
Yeah, it's a very important presser because all the bigwigs are going to be there. The Ministry of Finance, Ministry of Commerce, the Central Bank, the NDRC, which is the Economic Planner, and the CSRC, which is the Securities Regulator. So all the bigwigs are going to be present for reporters to ask questions. But bear in mind that these sort of press conferences in the past, the authorities tend to screen the questions beforehand. So it's not a free-for-all sort of press conference that you're used to in the West. So it'll be interesting to see what sort of questions they choose to answer that would give us a sense of what the government wants to communicate to the public. So when it comes to the PBOC Governor Pang Gongsheng, we want to look out for what he would say when it comes to the monetary policy, when and at what pace China will move towards that looser monetary policy that he has been pledging. Because so far this year, the PBOC has been laser focused on supporting the yuan. To what extent are they going to continue doing that, and to what extent are they going to tolerate a devaluing of the yuan to offset some of the impact of tariffs? That's one. And from the CSRC, we want to look out for any details on how they will resolve the financing problems that some smaller and medium enterprises face. There's also been a lot of talk about potential establishment of this real estate stock market, establishment of a stock market stabilization fund that's been talked about on Chinese state media. Will we get more details around that? Because policymakers or advisors rather have been calling for this fund to be able to inject liquidity in a timely manner when there are market shocks. So let's look out for that as well. The NDRC chair, that's the economic planner. We want to hear more details on how they plan to implement the strategies that were outlined in the government work report yesterday in terms of how they would boost domestic consumption and foster some of the emerging industries like AI, biomanufacturing, and the like. And there is MOFCOM. That's the agency that is in charge of outlining what measures China would take to counter tariffs. They have announced some of the countermeasures on Monday. We might hear a little bit more, perhaps the broad stance that China has towards some of the major trading partners like the EU and the US. Likely more signals that China will continue to open its doors to foreign companies and foreign investments as well.
So basically, we're looking for more clarity on policies and how policies will be implemented. I mean, so far, so good when it comes to the markets. You take a look at how, the CSI 300, HSI are moving today. They're basking in the afterglow. So there's been some satisfaction in what they've seen so far.
Yes, markets have been pretty reassured, I think, by that rather ambitious growth target of 5%, because bear in mind that the consensus forecast now is just 4.5% growth. So to get to 5%, that means the government will have to inject a significant amount of stimulus to get there, because it's the same target they set last year. Last year, they managed to achieve it. That was without a trade war. This year, the external environment is much more challenging. So investors betting that there will be more supportive policies this year, and you saw that in the deficit target. 4% is the highest that they have set in decades. They also raised the quota for local government and central sovereign special bonds as well. So all these are positive signals. And what stood out to me the most is the priority in that government work report. The number one task for the government this year is to boost domestic consumption, as opposed to promoting this high quality productive forces. That was the number one priority last year. Now that's relegated to number two. And it shows this almost maybe not a strategic pivot away from that old industrial policy, but it does represent a more sort of balanced macroeconomic framework here.
And consumption averages 50% of GDP, so it is an important component. Min, thank you so much for that. Bloomberg China correspondent Min Lo in Beijing. And you can also turn to your Bloomberg for more coverage of the upcoming NPC briefing on China's economy later today. T-Live Go to get your commentary analysis from Bloomberg's expert editors. Still ahead, my exclusive interview with ARM CEO Rene Haas discussing their new $250 million partnership with Malaysia on chip development. And we'll talk about the once-in-a-generation opportunity in AI data centers. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Malaysia's central bank is expected to stand pat in its rate decision later today, despite a recent run of cuts elsewhere across Asia, including Thailand. Officials are still optimistic over the country's growth prospects, including potential contributions from investments in Malaysia's chips industry. Errol is here to break it down for us? I mean, a huge ambition, right? We're talking about, the recent tie-up, and it's been in the chips business for a very long time.
Yeah, it has a long history in the industry. If you look at, though, the Malaysian economic growth this year, for starters, it's actually among the best performers in the region. So it's off to a really good start. And you look at the fourth quarter, faster than expected growth, helping it to reach its full year growth. But there are these concerns about Trump talking about chip levies. And for context, for its exports, about 40% of this came from electronics last year. So keep that in mind. And that is, as you alluded to, where this deal with ARM comes in. Flip the board. And I don't have to tell you about this, Haas, because you were the one who brought us the news. But for the purposes of this conversation, $250 million is going to be paid for these IPs to help it accelerate, potentially, right, reach this goal of own chip production, homegrown chips one day. And this is the boost that potentially could come to its GDP, 1 percentage points. Flip the board again. If you take a look at where it stands in the pecking order, it's the world's 6th largest in terms of exporter of chips. It is a big hub for assembly, for packaging, and we also know how it hosts some of these big players within the country. But you think back to the 70s, right, when it was really the heyday for Malaysia's chip industry. At one point, it was known as the Silicon Valley of the East, and then it kind of got its position ceded to the likes of South Korea and Taiwan. Now it's really a question of whether it can reclaim that position, move up the value chain when it comes to chips, and maybe one day produce chips for EVs, maybe one day for AI as well, Haas.
Well, that's right, and we know from Malaysia that it has a target of 5 to 7 years to produce its own chip. What kind? Yet to be seen. And of course, I spoke earlier with ARM CEO Rene Haas about his company's $250 million agreement to provide the country with chip designs and know-how over the next decade. Take a listen.
Semiconductors are complicated, and our ecosystem has really changed a lot. You're seeing many more governments getting involved in strategies and initiatives. Just look at the U.S. CHIPS Act. So I think what you're seeing today from the Malaysian government is a very significant step in terms of turbocharging and kickstarting an ecosystem.
$250 million for, a dozen IPs. Put that in perspective for us. How should we be looking at it?
Yeah, I think the way to think about it is typically companies that want to get started building chips are on their own, particularly if they're venture-backed. The government is now providing a Kickstarter, if you will, to the industry for fledgling companies to get started. It's not going to fund entire chip development, of course, but it does start and show government initiative around getting an ecosystem started. So I think it's a wonderful cause.
What does ARM bring to the table?
Oh, for us, it's our intellectual property. ARM is the world leader in compute, and our compute subsystems, which are used for server chips, automotive chips, PC, phones, it allows companies to get started really quickly to build SoCs. So we're bringing that platform.
It's great having the IPs. It is what you do with them that matters most. Where do you see the most potential, and how realistic is it for Malaysia to think it can produce a chip in the next 5 to 7 years?
Chips are hard, and designing chips are hard. There's a unique ecosystem here, though, around assembly and packaging and test. And if you look at the most advanced chips being done around AI, not only are the chips complex, but the packaging is complex. So I think one of the advantages Malaysia has is building on a very robust ecosystem and now adding design onto that, which I think they're very well positioned to do.
It is also about the talent gap. How do you bridge that gap, ensure that you actually have the skilled labor to actually make this work?
It's going to take people, obviously. We're going to help. We're going to be doing training. We'll be doing training.
How many people?
Well, we'll be bringing training here with our folks. We're working with universities not only in Malaysia, but universities in UK, US, where Malaysian students study. So we're going to pull out all the resources we can to enable this, and also getting VCs and investors involved to just start this ecosystem.
In terms of the biggest opportunities, and here I mean industry sectors, would perhaps EV be an attractive sector for Malaysia to be identifying or be investing into?
I think EVs are an example. Robotics is another example. Anything around AI in terms of servers and data centers. I think building on the rich assembly capability and testing and packaging, all of those are great opportunities. It's a very rich time to be involved in this, and I think it's going to bear fruit going forward.
Can it build the ecosystem it thinks it can? And what would it take? And what kind of time frame should Malaysia be looking at?
Yeah, I think this is the classic, when is the best time to build a tree 20 years ago? When's the next best time? Today. It's a start. And frankly, it's a start that I applaud the government for doing this. Not a lot of other governments have moved this quickly and been this ambitious. It's not going to happen overnight, but starting this way is a great, great step.
Can Malaysia be the third player after the US and China? Because today in my conversation with the minister, he expressed optimism that can happen.
It takes vision, it takes ambition, it takes will. And you saw in the speeches today a lot of that. So that's a great start, but it doesn't happen overnight. But we're thrilled to be part of it.
And that was CEO Rene Haas. Well, joining us exclusively now, Cathy Marcus, co-CEO and global COO at PGIM Real Estate. PGIM Group has almost $1.4 trillion in assets under management and is the third largest real estate manager worldwide. She sees a once-in-a-generation opportunity in hyperscale data centers. Yes, it is about AI, it is about data centers, but it's also very complicated when it comes to investing in data centers. Cathy, welcome.
Yes, thank you.
So why is it a once-in-a-generation opportunity?
The demand for data centers and for compute, essentially, is expected to grow by over 20% on a compounded rate over the next 5 years. So if you think about what other investment opportunities have we seen that have that kind of sustained, very high double-digit growth that is projected and has already been proven out, that's really what is so compelling about that. There's just not the supply of data centers, particularly in the hyperscale space. You mentioned hyperscale in particular, and there's just not supply to meet all of that demand. And the demand, we're already behind from a supply perspective, and the demand is going to continue to grow.
We're talking about massive amounts of investments, billions and billions of dollars when it comes to data centers. Some say that they're a pretty tricky game to play as well. If you take a look at what's happened in the UK, for instance, they've had to pull back on the development of data centers because of a lack of electricity, for instance. So how do you assess the risk and reward of investing in data centers?
So the governing factor around power, it's not just a UK thing. There are actually markets in the US where there's about a 3-year wait for power, and other countries have also had some power limitations. So that is a constraint, but that also really feeds into this investment opportunity in that because of the constraint to power, because of the constraint around know-how in terms of really knowing how to build these, how to operate them, that just puts a governor on new supply. And so again, that really means that you're going to have demand continuing to far outstrip supply, which of course brings pricing power.
So lots of opportunities. We know Malaysia is trying to build its data centers. Japan is trying to build its data centers. I mean, the UK doing the same. Where do you see the best opportunities for you to be investing in these data centers?
We see a lot of opportunity in Japan, in Australia, in the US. Certain areas of Europe as well, where the climate is particularly good for data centers. So it really depends on what the activity is going to be in the data center. So as an example, there are certain activities like training of AI where you can bear some level of latency. There are other activities where latency there's just no tolerance for it, and that will determine some of the locational issues. And other factors in terms of location have to do with the availability of power and the cost of power.
Cathy, let's pull out and take a look at real estate as a whole. People have been talking about a recovery in real estate for some time now.
Yes.
They say perhaps 2025 is the year. Is it the year?
We think 2025 is the year where there's going to be demonstrable recovery. So really what we saw over the past, call it 2.5 years, is a very kind of painfully slow repricing of the sector. We are a private asset class, we're an illiquid asset class. So it can take a very long time to have a complete repricing. In mid-2024, we really kind of called the bottom of the repricing, the end of that long period of time. And what we've seen since then is a stabilization of pricing really around the world. But we've also seen in certain geographies and in certain sectors, we've already seen values starting to go up. And we've seen that for the past couple quarters, and we're actually expecting to see that early this year as well. And so in mid-24, what we told our investors is the time is now to start investing. And what I would say now is the time was yesterday to start investing.
So if you have missed the boat, you've missed the boat. That's not coming in anymore.
Well, this boat is going to be going for a while, right? Because we're not talking about a spike recovery. We're talking about a slower recovery that's actually going to be very income oriented. So what we're really looking for in this recovery, and what we're already seeing, which is quite unusual, is income growth. And income growth obviously is very supportive of real estate value growth, and it's a much more sustained way of increasing real estate values. And what's unusual this time is that we're at the beginning of a cycle. Usually when you're at the beginning of a cycle, there's destruction all around you, and it takes a while for you to start to realize any level of income growth. But what we're seeing that's different in this cycle is we're already experiencing income growth.
But what's driving this recovery? Which sectors are driving this recovery?
It's certainly not unilateral, so that is very clear. We've just talked about data centers, definitely one of the factors. Another theme that we have a lot of conviction around globally is what I'll call the living sectors, kind of any type of housing, ranging from very traditional multifamily rental apartments to student accommodation to seniors housing. So it's really everywhere on that spectrum. And we know that globally there is a shortage of housing. There's a shortage of housing that is affordable. There's a shortage of housing that can serve certain demographics, with seniors housing being a perfect example there. And really what is driving that value and that income growth is the lack of supply. And when interest rates started going up in 2022, one of the things that we saw is that the level of supply in new construction became very muted. And so we went into that with already a structural shortage of housing, and then that was exacerbated by the high interest rates, high construction costs, high labor costs. A lot of deals didn't pencil. And so now we find ourselves with really even more of a shortage of housing.
I'm just wondering whether the recovery you're anticipating might be hampered by this higher for longer environment in rates, and also Trump's tariffs, making people a bit nervous about investing further.
Sure, and I think that, we are, in my view, going to be in a higher for longer interest rate environment, right? But the reality is that the market has metabolized that in some ways. I would say that the second half of 2022 and 2023 in our industry, very, very low transactions activity. There was just this huge gulf between buyers and sellers and expectations, and a lot of that had to do with buyers and borrowers were a huge non-bank lender, one of the largest, just really not accepting the new interest rate environment. But we've seen that toward the end of 2024, really, mid-24 and on, we started to see more of an acceptance of where the interest rates are. And clearly there's still some volatility, but just in our business, we're investing in 21 countries around the globe. Between 2023 and 2024, we had about a 25% increase in investment activity just within our own business from an equity perspective, and about 12% increase in our lending activities. So that is really driven by more transactions activity in the market.
Talk to us about office buildings. Quite interesting. During COVID, we had CEOs saying, stay home, no need to come to the office, and the offices were pretty empty. And now they're saying, come back, if you want to keep your job. How are you looking at demand for office buildings?
There's really incredible bifurcation in the office market, and part of the appeal to employees to come back to the office, one of the tricks is to provide a really nice space for your employees to come back to. And so there's really just a shortage globally of super high-end, fit-for-purpose today, ESG certified, everything that people want, great public transportation. There's just not enough of that space. And so if you think about even markets in the US where office utilization is much lower than other parts of the world, in particular in Asia, but even a market like New York where you're still maybe 60-65% office utilization, there is very, very little in the super high grade office space available. It's almost impossible.
But the thing is, as recent as late last year, we were reading reports about how the office space is a ticking debt time bomb. would this recovery in the office sector take much longer than you actually anticipate?
I think it's going to take a long time. It's already taken a long time. The reality is that many office markets were already struggling pre-COVID. That was just kind of, the cherry on top, really, in terms of office repricing and people, thinking maybe a little bit differently about office. But for me, I mean, I've been in commercial real estate for over 35 years. This is like the fourth or fifth time that there's been some giant wall of debt that was going to, implode the entire industry. It just doesn't happen because it gets smoothed out. People extend their debt. Lenders work with borrowers. People find alternate uses for buildings. So personally, I'm not concerned, and we're not concerned that there's going to be this, crushing amount of office debt that suddenly is going to come due.
So no tipping point, because we have the likes of Blackstone already, seizing payments on their buildings because they see greater value in deploying the cash and resources elsewhere.
Yes, and lots of people are doing that. And again, we're a huge lender, so we have a little bit of that in our portfolio as well, but that is not the entire story. That's a slice, and generally that is office that probably should no longer be. That's not super grade A office.
Private credit, lots of interest in that. Is there a reason to be nervous about it? Because people talk about, possibility of a lack of governance, and hence, you could be looking at potential crisis. How are you looking at that?
I think that maybe some people could be nervous about all of the hype around private credit because they're thinking of it as something that's new, and it's this new thing that's, been talked about constantly. The reality is that, private credit, that's a mortgage. Right? We made our first mortgage in 1878. This is not a new construct. There's governance around private credit.
We're talking about massive amount right now.
It is massive amounts, and there are a lot of players. But it's really, the ecosystem is important. The fact that there are banks and there are non-bank lenders. We all work together in order to really make a functioning market. So as a non-bank lender, the fact that banks are leaning in a bit more in certain markets, particularly in Australia is a good example, that's good for a non-bank lender, and that's good for borrowers. So overall, we think that the availability of credit is really important and supportive of the investing.
Where are you seeing the biggest growth when it comes to private credit? I mean, you're functioning pretty much globally. Where are you seeing the greatest demand?
I think the demand geographically is pretty ubiquitous out there. But what I would say is when I talk about our first mortgage in 1878, that was a very core senior loan type profile. And where we're seeing more interest is in higher yielding real estate credit in particular. So I think that people's definition and idea of the role of credit in real estate has expanded and become more creative.
Where is PGIM looking at investing in the next 12 to 24 months? Because I've seen from reports suggesting perhaps that you're now, I think among your most recent investments is actually in the Middle East.
So in the Middle East, we're investing in things relating to technology and our business, and we have an innovation lab that we're working on some partnerships in the Middle East. And it's really an innovation lab that's meant to promote innovation and technology for the real estate industry generally, with a particular focus on sustainability and climate. So that is an area of our business that we're investing in quite a bit. From a investing capital in real estate perspective, we really like, I mentioned the living sectors, data centers, logistics. We like logistics really all over the place. We're still very, very bullish on logistics in Mexico. In fact, and you mentioned the Trump tariffs. I have an American accent, so you can imagine that I'm talking about this a lot. And we still feel a lot of conviction around the industrial market on the Mexico side of the border. There are long-standing supply chains that have been built there that, you can't just undo those supply chains because there's a tariff. And what I think is really interesting is, and who knows where all these tariffs I mean, intraday, the news is changing, right? But we recently sat down, our team on the ground in Mexico recently sat down with a lot of our tenants in our industrial buildings on the Mexico side of the border that tend to be doing some light manufacturing. That's the most popular thing that they're doing there. They tend to be either American or multinational companies. And while I wouldn't describe them as very excited about the tariffs, that does not change their value proposition for having their business in Mexico and for all of the back and forth that happens across the U.S. and Mexican borders.
Given the optimism, what would you deem as the biggest risk to the business this year?
I would say the biggest risk is, you mentioned this higher for longer, and I mentioned that I feel that we have, as an industry, kind of accepted where interest rates are, but I don't think we would be so accepting if they went higher. It's taken quite a bit for everyone to get their head around where rates are right now. And so to me, a big risk would be if the rates, if there was a lot of volatility in the markets and you started to see rates go back up.
Do you see that risk in China? Is that why you're reluctant to put money in China?
I think that there's a risk everywhere around interest rates. I mean, the way that...
What would it take for you to invest in China?
We're not doing a lot in China right now because of the volatility. And I would say that we would have to really see a sustained period with, calm and feeling that, that volatility would not be constant. And there's always volatility in the markets. I mean, every place that we invest has volatility, but the level of volatility in China, it has been a bit much lately, particularly in the property markets.
Cathy, thank you so much for your time.
Thank you.
Thanks for dropping by. Cathy Markets, co-CEO and global COO of PGIM Real Estate. Plenty more to come. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. The European Central Bank is expected to lower rates later Thursday for the 6th time since June. Analysts polled by Bloomberg almost unanimously predict a quarter-point cut in the deposit rate to 2.5%. But beyond that, opinions on where to take borrowing costs vary pretty much, with some predicting no more reductions and others expecting the benchmark to reach 1% in early 2026. We're keeping an eye on European assets. The euro in particular, we saw the biggest jump since 2015, the biggest rally since 2015, and some say perhaps the euro has a 10% upside from here. Take a look where we are in terms of the euro stocks futures, pointing to a higher open up 0.6%. DAX futures also in positive territory. The pullback in terms of U.S. commitment to Ukraine has perhaps meant greater spending on the part of the European countries, hundreds of billions of dollars expected in spending in defense as well as infrastructure. We'll have more on that ECB decision. Keep it here with us. This is Bloomberg.